world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello, and welcome to Rebank. I'm your host, Will Beeson. After working across banking and financial services in the US and continental Europe, I've settled in London, the heart of all things fintech and banking innovation. This podcast is a platform to explore some of the ideas, the thoughts, the trends that are reshaping the world, and along with that, the way we conceive of banking, finance, and money. The interview format will give us the opportunity to dig into some important ideas and to get some of the leading thinkers in fintech and banking on and chat through what's going on, what the implications are likely to be for society, how we're going to see things change in the coming years, both in banking and financial services and otherwise, and try to draw some conclusions about what this means for our industry. And definitely reach out, get in touch, tweet at us and the podcast at Rebank Podcast. Look forward to hearing from everyone and enjoy. Today I sit down with Jeff Tijssen. Jeff calls himself an experienced executive, but I call the guy a legend. Listen to this bio. Jeff has an extensive background in financial services and consulting, having worked for and with banks including HSBC, Lloyds, Halifax, Bank of Scotland, Nationwide, RBS, ING, ABN AMRO, Rabobank, and more. During the day, Jeff runs Capco UK's Fintech practice, but he doesn't waste his free time. He chairs the Fintech and China working groups at Tech London Advocates, a private sector coalition committed to championing London as a global tech and business hub. He's also a member at a number of accelerators, including Startup Bootcamp and Virgin Startup, and is a regular speaker and moderator at tech conferences and events. Jeff's an active liaison between UK Fintech and Chinese capital, regularly traveling to China to promote UK startups. Jeff also sits on the advisory board at Code First Girls, a social enterprise helping more young women get into technology. If that weren't enough, Jeff is an executive committee member of Institute of Directors, City of London, where he leads the group's fintech activities. Jeff has joined us today to discuss what he's seeing in the world of incumbent banking and challenger banks. Jeff has unique insight into the challenges and opportunities faced by incumbent banks in the UK. There's a lot going on right now, but Jeff's got a front row seat. Let's hear what he has to say. Welcome to Rebank. I'm your host, Will Beeson, recording live from London with Jeff Tijssen, managing principal at Capco and head of Capco UK's Fintech practice. Jeff has spent a lot of time with incumbent banks on modernization, strategy, innovation, working inside and outside those organizations, understanding the challenges that they face, the opportunities that they face, and he's here to chat about it with us today. Welcome, Jeff.
Thank you, Will.
So, firstly, maybe you can confirm that I correctly characterized your role and tell us a bit more about what you do in practice.
Spot on. So I look after fintech and partnerships for the UK and the rest of EMEA. So a lot of the work that we do in the digital and the innovation space, a lot of partnerships that we have with different startups, with venture capital firms, with accelerator programs. So we've spent a lot of time in the past couple of years building this ecosystem that we can tap into. So we're getting more and more requests from our clients to support them in the digital and the innovation space. And instead of just leveraging our own knowledge and expertise, what we're doing more and more is we work very closely with different startups. We bring them into client workshops. We work together on client pitches and RFPs. But we also use them to educate our own staff about what's happening in the market. As you can imagine, there's an awful lot of interest from people within the organization in the fintech space, whether it's blockchain or machine learning or AI or lots of other exciting areas in the fintech space. So we organize events every 2 to 4 weeks where we bring in different startups to talk about what it is that they're doing and how they are looking to disrupt or work with some of our existing clients.
That's an interesting point, that last one, the disruption versus partnership, and hopefully something we can get into later, because a lot is said at the moment. Probably 12 months ago, there was a big shift from disruption to cooperation. I'm a bit skeptical, I think, about how authentic the motivations are on both sides, but we'll get into that. So in terms of incumbent banks and fintech, you work closely with a handful of the big four, big five banks in the UK. Is that right?
Correct.
And I suppose having been on the inside, understanding the way that innovation processes work, partnership processes work, do incumbent banks, are they on the fintech bandwagon? Do they see kind of banking and financial services disruption coming down the pike? Is the world going to look fundamentally different 5 years from now in the eyes of a Lloyds Bank and HSBC and Barclays?
It's a good question, Will, and I think I've definitely seen a significant shift in the past 12 to 18 months. It wasn't that long ago when Jamie Dimon said Silicon Valley is coming for us. So I think you've really seen a significant shift in the banking space, whereby organizations have kind of moved away from seeing fintech startups as a threat, and now it's your collaboration is the key word, basically, right? So that they all want to work together with fintech startups. A lot of banks have either set up their own accelerator program, they're partnering with an accelerator program, whether it's a Techstars or a Startup Bootcamp or some other organizations, or they've set up an investment fund to work with and invest in different startups, whether that's a Santander or an HSBC or Barclays, other organizations who've done one or multiple of those things. I do think that the banking landscape is changing significantly. So I think you're seeing a fundamental change at the moment in the banking landscape. Technology keeps on changing. Banks are finding it difficult. They're under a lot of pressure to reduce cost. There's a regulatory burden as well, whether it's new regulation like PSD2 or open banking or MiFID 2 or you name it. So there's a lot of pressure on them to on one hand be more innovative, but on the other hand comply with all the new regulation that's going to kick in the next couple of years as well.
Okay. One of the kind of prevailing views is that incumbents are kind of too steeped in legacy infrastructure, systems, personnel, processes, that there's really not much they can be doing in the short term to catch up, and that therefore, this kind of death by a thousand cuts, slow erosion of business lost to startups ends up kind of fundamentally destabilizing a lot of the incumbent institutions. What's your view on that, and what would you say the incumbent bank's view on that risk is?
I think it very much depends on the organization, Will, and I think a lot of it depends on the people running those initiatives as well. I've seen some great examples whereby the people in charge of running digital and innovation across the enterprise are very, very successful and have really managed to change the way that the organizations operate. And in other cases, the organizations are less successful. It does help to have a bunch of people who've done this before, who've got some good experience in this space, and are capable of changing things. With regards to your first point about legacy systems, the need to change the culture in the organization as well, it's not easy, right? We all know that there are a significant number of banks out there who have underinvested in technology for a significant number of years. Building new services or integrating with fintech startups isn't necessarily that easy because of those legacy systems. Also, if you look at new regulation that's kicking in, such as PSD2, which is all about open APIs, for some banks it is quite challenging to go and do that and to provide external access to to certain data via different systems. There's a wider use of open APIs.
And I guess that's part of the question. Is the foundation stable enough to support these new business models, API integrations, fintech partnerships, or are they effectively building on an unstable base in a way that some number of years from now is going to come back to bite them?
I'm seeing a bit of both at the moment. As it is, there's quite a large number of financial institutions at the moment that are looking to replace their core banking systems. So big transformation programs happening across the industry. So there's a lot of that at the moment. If you look at companies like MuleSoft and Apogee and others, we're very much focused on the API space. They do make it easier for companies to build and develop their API portals and plug them into their existing systems. A lot of companies are doing both at the moment. So a lot of them realize that there is a need to change. There is a need to change the underlying infrastructure and architecture, and are investing a significant amount of money into doing that. Change doesn't happen overnight, so it's a bit of a longer term play. Very interesting to look at what some of the new challenger banks are doing as well, whether it's a Mondo or some other new banks that are coming onto the market, who have kind of adopted a different approach when it comes to building the underlying technology. As opposed to spending 3, 4, 5 years implementing a new core banking system from one of the more traditional providers of core banking systems.
On that note, speaking of challenger banks and IT, the Fidor acquisition recently, I do wonder how much that is the challenger bank, the challenger brand that was being acquired, and how much that was the IT infrastructure. Do you have thoughts on that?
Good question. My understanding is it's a bit of both. Right? So I've been a big fan of what Fidor has done. I think they've been a leading example of how to properly leverage APIs and make sure that whatever you build is very modular and it's easy to change. And so I've been a big fan of what they've done in the past couple of years. I think if you look at some of the recent acquisitions, what a lot of banks have done is, instead of merging both organizations, sometimes they've kept the newly acquired organization as a standalone unit, and they position that bank effectively as the hip, cool brand. So when new customers come on board, they effectively join a new organization. So they come onto that platform as opposed to coming onto their existing platform. So it gives banks an opportunity. You've seen the same with Atom as well, with other banks taking a majority stake in Atom and Starling and a few other organizations where you've seen something similar. But it gives the incumbent bank an opportunity to position that brand as the digital brand that attracts potentially a different target audience from their current target market.
Yeah, that, and I think with Fidor specifically, they've developed their core banking engine as a standalone offering, effectively Fidor OS. I think they called it. Let's see if they continue calling it that. But and so I can totally see the attraction for a group of kind of mutual banks in France. That in places like Italy or Spain, where groups of local, often community mutual type banks were kind of conglomerated over time and likely still run on different core banking engines. I could totally see the appeal of a great kind of API driven core banking platform that can quickly plug in and replace dated infrastructure across a group of disparate systems.
I could agree more, and I think it's something that a lot of banks are looking at the moment. Right? So what does the bank of the future look like? Is it The same as what it is today. Is it more of will the bank effectively act as a platform, right? But if you want to develop new products, new services, roll out new functionality, you effectively leverage external parties, third-party providers, via the use of APIs. To me, the fact that every single bank, because you don't necessarily differentiate via your core banking system as a financial institution. So to me, the fact that every single bank is building their own core banking system doesn't necessarily make sense. We all know how complex and how costly it is to build and implement a new core banking system.
I think one of the potentially interesting changes in coming years across banking will be a move away from the kind of the industry landscape the way it currently looks, where you have banks in North America, you have banks in Europe, you have banks in Asia that all effectively look the same, have the same types of products, serve the same customer segments. And I wonder if going forward the market doesn't fragment a bit, where you end up with with platform banks serving retail customers, potentially maybe more digitally native, tech savvy customers. You have more kind of hands-on, face-to-face, relationship management focused banks serving older or older segments of the population or high net worth segments, small businesses, whether you have kind of certain banks dedicated to corporate customers and starting to kind of move across cash management to FX to some other even supply chain related issues, whether the bank business model stops being so homogenous and starts kind of fragmenting a little bit.
It's interesting, right? So I think you've seen some really interesting developments in the past 2 to 3 years. If I take the UK as an example, so the UK government wants to see more competition in the banking space. As a result of that, and for a number of other reasons, you've seen a fairly large number of new challenger banks coming onto the market. But then what you've also seen is some of the larger players taking a majority stake in those challenger banks or actually acquiring those challenger banks. So it kind of defeats the purpose of what the UK government was originally trying to achieve. I think the other thing as well is for some of the challenger banks that have been on the market for a little bit longer, but we all know how sticky customers can be. So if you take the UK account switching service as an example, the uptake has been fairly limited. Right? So as a challenger bank, you're going to have to work really, really hard for customers to actually switch. I've been with my bank for a long time. Have I always been very happy with my bank? No, not necessarily. Have I decided to switch to another bank? No, not yet.
Yeah. Well, that said, I think the challenger bank rebuttal to that to that point is that currently, one of the few retail-focused challenger banks that's actually live is Adam, and they offer a savings account and nothing more. The current account providers active in the market are the same incumbent banks that have been in the market for 100 plus years. Broadly speaking, there isn't much differentiation between one and the other. So I think it'll be interesting to see once a handful of challengers come to market with fundamentally different propositions, whether that changes the consumer's interest in switching.
Yeah, I think so. And also, if you look at how some of the new challenger banks are trying to position themselves in the market, I think it's fantastic to see, Amondo or some other challenger banks. If you look at their crowdfunding campaign, breaking records, they've really created a bit of a buzz around their brand as well. I think Mondo at the moment has got 30,000 customers who are participating in their pilot effectively, but I think there's a wait list of 200,000 people. So the fact that they've managed to create quite a bit of a buzz in a relatively short period of time is quite an achievement.
So, kind of switching gears and moving back to the conversation around incumbent banks. You mentioned both legacy IT systems as being a challenge and culture. In your view, which is more of a challenge?
I I don't think you can change one without changing the other. To be perfectly honest with you, I think both are a significant challenge at the moment for financial institutions. There's absolutely a need to change the underlying infrastructure and architecture, so change those legacy systems. There's a big need for rationalization as well. And so lots of different systems that are being used as opposed to just using a single system, which makes it a lot easier to then deploy new functionality as well across your customer base, as opposed to having to work with 10 or 20 or 25 different systems. I think when it comes to changing culture, to me that's probably a key thing. I think for big financial institutions to be more innovative, I think it does require a bit of a cultural change. To be fair, though, I think if you look at what banks have managed to achieve in the past couple of decades, they've actually been quite innovative. Right? Whether it was ATMs or other technology that has been launched in recent decades, they've actually been fairly innovative, believe it or not. But I strongly believe that there is a need to change the culture. What's been interesting as well to see is a lot of banks have decided to effectively run their innovation units as a standalone autonomous unit. Whether that's Barclays or other organizations as well, who've their teams are based in a different location. They work very closely with startups as well. They really try to learn from them, leverage their technologies, but then bring in executives as well to those locations, so they can also learn from what these startups are doing and how they think and operate in a different way. So why is it possible for a startup to build, develop, and launch a product in a couple of weeks? And in a big financial institution, it might take a year or 2 years to actually go and build that for a number of different reasons.
And is that structure in which the innovation department sits off-site compared to other parts of the business, is that beneficial because it keeps the innovation department independent and free-thinking, or is it an attempt by senior management to kind of keep innovation out of sight, out of mind?
I don't think it's the latter. I think giving the innovation team the flexibility to do things in a different way, be a little bit more disruptive, and effectively run it as an autonomous unit, to me is probably the right thing to do. However, if the innovation team then comes up with lots of bright ideas, but they fail to implement those ideas within the organization, then it's obviously not considered to be a success.
How easy is it for innovation groups to get management buy-in to actually make change?
Again, I think it comes back to my earlier point around the need for strong leadership as well. And I think there's, if you look at banks at the moment, there's plenty of people that have some bright ideas, and there's lots of stuff that they would love to change. But then there's a big difference between coming up with an idea. So you come into the office on a Monday morning with a bright idea and actually delivering that idea as well into production. Two different worlds. So I think it requires very, very strong leadership as well, and breaking down barriers. Lots of things, if there are existing governance processes, existing change processes for delivering new change into production, and if that kicks in from day one, so you kind of want to do innovation in a slightly different way, especially in the early stages of the life cycle. So you want to test and validate your idea rapidly. You should be able to build an MVP and do rapid prototyping and all that in an agile fashion, so you can do it very, very quickly. And if it doesn't work, you kill it, as opposed to spending 6, 9, 12 months defining requirements and then only starting to build something.
Are we going to be surprised by what we see coming out of incumbent banks the next 2 to 3 years? Are there some dark horse incumbents that are about to take the market by storm?
I wish I knew, because I would probably put a lot of money on that, Will. But I think so. Again, when I look at what some of the challenger banks are doing at the moment, and again looking at the UK market and also what's happening in Germany, not just with Fidor but also with number 26, for example, I think there's some really, really interesting trends and developments, and the larger, more established financial institutions, they're all looking at this stuff as well. Will there be some dark horses? I think so, but then again, it comes back to my point about the fact that customers are relatively sticky. So challenger banks are going to have to work really, really hard to win the hearts and minds of new customers, and making sure that they leave the big four or the big five in the UK and switch to one of the new providers.
So coming back to the point on competition versus collaboration, disruption versus partnership, I think you mentioned that that partnership is the prominent theme at this point. Are you seeing that work between fintechs and incumbents in a meaningful way that's profitable for both sides?
Again, I think it very much depends on the organization that you're dealing with. I've seen good examples and I've seen bad examples. As I said, some organizations have decided to set up their own accelerator program. Others are partnering with an accelerator program. It very much depends on what is it that you want to get out of it as a bank. Is it a bit of a PR exercise to say we are being innovative and we are working with startups, but then the reality is it's actually really, really difficult for those startups to integrate their services. Or are you actually very serious about doing this, and you're working very, very closely with the business to understand what their needs are, and you search the market for interesting startups that can help you to address those issues. There've been a few examples of large financial institutions that have either acquired a fintech startup or are working very closely with startups. But I don't think there's a single financial institution out there at the moment that is not looking at this space.
I mean, I guess I would almost kind of break fintechs into two divisions, two categories. One that looks to generate new revenue by providing certain services better than banks do, or slightly different services that banks aren't offering, that banks could potentially partner with to support the top line and potentially do things in a more profitable way. And fintech businesses that look to effectively increase the efficiency of internal processes, KYC, AML type stuff, infrastructure plays, ID, authentication, verification. Do you see a stronger interest amongst incumbent banks in one versus the other type of fintech, and how you expect that to develop in the coming years?
That's a very good question, Will. There's definitely an interest in both areas, right? And I think if you look at the value that a fintech startup can provide to a large financial institution, then I think there's lots of different benefits that fintech startups can bring. Also, if you look at the breakdown or the different areas that have fintech startups operate in, and what are some of the most popular areas, whether it's payments or KYC or obviously lots of blockchain startups in this space as well. Banks are definitely looking at both. Cost reduction remains very high on the agenda for every single institution, whether it's a large retail bank or whether it's a large investment bank. A lot of investment banks are looking at things like machine learning and blockchain and AI, and how they can leverage the services that startups that operate in that space provide to improve efficiency, reduce cost, etc., etc. In addition to that, they're also looking at the same technologies, but how they can build new, cool, exciting features that they can then roll out to the market. So they're definitely looking at both, but as a cost reduction remains very, very high on the agenda for every single financial institution. So definitely an awful lot of interest in that space.
Another I guess part of fintech tech that could be hugely impactful. Technologies like blockchain that support cross industry propositions. So whether it's new kind of real time payments, which I think in the UK with faster payments you generally have, but a lot of markets new payment frameworks could be implemented. Certainly KYC type information. If that's not owned by a single bank, but something that can be shared between banks, those sorts of solutions would certainly be the most impactful for the industry as a whole, for banks individually, but at the same time they're the ones that require kind of the broadest buy-in across organizations who traditionally aren't particularly good at collaborating with each other. Thoughts on whether or not any of those potentially powerful solutions will ever come to fruition?
I think so, and I think it's still early days. Lots of financial institutions are looking at blockchain. More than 40 different banks. They're all part of R3 and trying to work together to develop common standards and common protocols for blockchain. A couple of different use cases that they're looking at the moment. But you need to keep in mind that the blockchain only works if you have so the more the merrier. Right? So as a financial institution, if you use the blockchain just for your own institution, the use cases are relatively limited. So you really need to look at widespread adoption of that technology in order to get the most out of what blockchain has to offer.
It's interesting to think about in the context of the whole blockchain discussion. So much is said about cost savings and efficiency enhancement, which is great. At the same time, banks as intermediaries, points of friction, almost by definition, are generally the parties that benefit from the inefficiency because there aren't easy ways of transacting. Their roles are necessary, and because their roles are relatively complicated, not particularly efficient now, they're able to extract rents effectively from those activities. It would be great if letters of credit, trade finance were done in an automated, transparent way across banks, importers, exporters, worldwide on a blockchain. But if you cut out all of the inefficiency, how do you justify generating revenues?
It's interesting, right? So I think one of the reasons why you've seen so much interest in blockchain recently is because banks realize that the technology itself has an awful lot of potential and can be used to address a lot of the inefficiencies that you're seeing in the market at the moment. It kind of comes back to my earlier point, though, that in order for you to get the most out of blockchain, you're going to have to work together, and different financial institutions working closely together. Banks also realize, though, that if they don't look at this now, with the technology that's evolving so quickly and lots of different fintech startups trying to disrupt some of the larger players, so if they don't act on this now, then someone else might eat their lunch in the next couple of years. And if you take TransferWise as an example, has been quite successful in recent years. So the market for international payments is growing. A lot of the large banks, they're losing market share, and they're losing market share not necessarily to one of the other large financial institutions. No, they're losing market share to a TransferWise or one of the other players that's operating this space, because they offer a much better customer experience at a much lower price. So from a customer perspective, it's a much better proposition than using one of the large financial institutions.
We touched previously on acquisition. I think we were talking about Fedor specifically, but there have been a handful of other examples in the US, the UK, Europe. How do you view I ask you this based on your experience working with incumbents. How do you view acquisition as a strategy for incumbent banks? Is it viable? Is it actually a way of bolstering the organization, the proposition, or do acquired companies tend to die quick deaths inside large organizations?
It very much depends on what it is. I mean, this applies to every deal that you do in the M&A space. Right? So it very much depends on what is it that you want to get out of the acquisition. So is it you want to target a different customer segment? Is it you want to position the brand that you're acquiring as the cool, hip brand? Is it because of cost efficiencies? It could be a number of different things. Right? So I was reading an interesting article the other day about the merger and acquisition space, and the majority of mergers are not successful for a number of different reasons. Again, a lot of it came down to cultural change as well, and not really being clear on why you want to acquire a particular company. But looking at the banking space, you've seen a number of different examples. HSBC has done it with First Direct, and they made a deliberate decision to keep First Direct as a separate brand. Lloyds acquired HBOS during the financial crisis. There was the launch of TSB. You've seen WNG, which hasn't been
a debacle.
So you've seen different examples, and what's been interesting to see though is quite a few organisations or financial institutions that made those acquisitions kept the brand as a standalone brand effectively, as opposed to merging both organisations.
All right, so taking a step back and looking at the industry as a whole, what are the macro trends that we're likely to see in banking and fintech in the coming years? I think to buy you a little bit of time, because I realize it's a big question. The UK government and more recently CMA in the UK have come out with clear guidance that they're expecting to see open banking, i.e. kind of open access to data and API-based sharing of data across banks. That is a hugely powerful trend if it is indeed to come to fruition. One that I think would be the envy of the rest of the world. Major trends that we're likely to see in banking and fintech going forward.
The cost reduction agenda remains. This is a very high on the agenda for every single financial institution. I don't think that will change anytime soon. So I think banks realise that they need to be more efficient. Cost to income ratios are still far too high for a lot of financial institutions, and I don't think that will change anytime soon. The regulatory agenda, again, I don't think that will change anytime soon. I think we'll likely see more regulation kicking in the next couple of years. So I don't think, again, that will change anytime soon. Open banking is an interesting one, and I do believe that open banking will fundamentally change the banking landscape. It reforces banks as well to rethink their operating model. Right? Again, if you take PSD2 as an example, there's a lot of banks saw PSD2 as yet another regulatory initiative. The reality is that, depending on how you position PSD2 internally, it can actually be a very, very interesting opportunity that opens up new revenue streams for banks. So very, very interesting to see those developments as well. But as I do believe that open banking has the potential to fundamentally change the banking landscape.
Great. Let's see. We've covered a lot. I'm very appreciative of your time, and realize that you have another engagement that you need to run to. So thanks very much, Jeff Tijssen of Capco, for coming on.
You're very welcome.
Pleasure.
Noah.
huge thanks to Jeff for joining today. Get in touch on Twitter at Jeff Tijssen, JEFFTIJSSEN. Thanks for listening. Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.